Welcome back to The Explainer. Okay, right now, the global tech market is undergoing a massive structural divergence, and it's totally challenging a decade of investment orthodoxy. While everyone is out there fighting over $1,000 NVIDIA shares, and the market is just absolutely obsessed with AI hardware, the essential software companies, the ones that actually run the world, are quietly trading at historically cheap valuations. We are talking about a true cyclical nadir here. So here is the billion-dollar contrarian question we are answering today. With generative AI automating everything from coding to copywriting, is this recent historic software crash a value trap? Meaning, are these businesses fundamentally obsolete now, kind of like Blockbuster in the age of streaming? Or are we actually looking at a once-in-a-decade 10x entry point into the world's most resilient business models?
Okay, let's actually dive right into this because the divergence in the NASDAQ right now is incredibly stark. If you look at the landscape in early 2026, the hardware sector is glowing bright green. It's fueled by immediate data center capex growth of over 50%, just pushing to record highs. But on the flip side, the software sector is bleeding red. Sentiment has completely washed out, pushing valuations all the way back to levels we frankly haven't seen since 2018.
Here is our roadmap for today. 1. The hardware hegemony. 2. Decoding the software washout. 3. The alpha value gap. 4. Moats versus AI vaporware. 5. The AI pivot trap. And finally, number 6, the contrarian sector rotation. All right, let's kick things off with part 1, the hardware hegemony. We are basically living in a brutal two-speed IT market right now. Semiconductor ETFs like SOXQ and FTXL are up massive double digits. And why is that? It's because the tech giants, the hyperscalers, are engaged in an absolute arms race. They're pouring hundreds of billions into chips to build the underlying infrastructure of the AI era, and it's driving unprecedented equipment demand. Meanwhile, your traditional software and cloud ETFs like IGV and EM Cloud, they're down over 20%. Capital is quite literally being harvested from software budgets to fund the massive physical infrastructure you need to train and run these generative AI models. Because here's the thing. Enterprise budgets are essentially a zero-sum game. Gartner's 2026 forecast shows data center systems spending surging an incredible 55.8% to nearly $788 billion. Software growth, comparatively, is heavily muted at just 14.7%. It's kind of like a homeowner taking the budget meant for everyday maintenance, plumbing, and roofing, and pouring every single cent into building a massive, futuristic garage. As organizations scramble to find the capital for $40,000 AI GPU units, they're aggressively cutting their traditional software as a service spend. And that creates a massive liquidity vacuum for software vendors. Which leads us to part 2, decoding the software washout. Now, I need to hit you with the brutal truth here. $285 billion. Let that sink in for a second. That is the amount of market capitalization erased from the software sector in just a 48-hour window during February 2026. This wasn't a normal market correction. It was a violent reclassification event. Wall Street completely freaked out and aggressively re-rated business models based on the emerging threat of autonomous AI agents. LegalZoom dropped nearly 20% in a single day. Thomson Reuters went down nearly 16%. Why? Because the market suddenly concluded that traditional per-seat pricing models are structurally overvalued in a world of agentic automation. Let's break that down mechanically. Previously, a law firm might pay for 50 Thomson Reuters software licenses for 50 paralegals. But if an AI agent can ingest case laws, synthesize precedents, and draft a brief autonomously, well, that firm suddenly only needs 5 human reviewers, right? And therefore only 5 software licenses. The market is demanding outcomes now, not just access, and that shift absolutely terrified investors. But panic always creates opportunity. Part 3. The alpha value gap. Now, what's really interesting here is how panic creates incredible mispricing. Consider Adobe's fundamental divergence. Back in 2018, Adobe was a $9 billion company trading at 12 times its enterprise value to revenue. Fast forward to April 2026, Adobe's annual revenue has scaled massively to $26 billion, and gross margins actually expanded to 89.4%. Yet, its EV to revenue multiple has been crushed to just 3.8 times, and its forward PE is down to 11.3. They are literally 2.8 times larger today, incredibly profitable, yet trading at multiples we haven't seen in years. That is wild. And it's not just Adobe. We're seeing this massive price-to-sales compression across the entire sector. Snowflake is down almost 92% from its peak. Workday, down 80%. ServiceNow and Salesforce down over 70%. These are incredibly high-quality, cash-generating franchises. This sector-wide compression represents the true value gap. It's where high-quality companies are deeply mispriced due to systemic selling exhaustion. Institutions basically just dumped software to go buy NVIDIA, regardless of the underlying business health, and it created a total disconnect between price and actual fundamental value.
So how do we navigate this safely? Part 4. Moats versus AI vaporware.
So the crucial point in avoiding a falling knife is understanding the difference between deterministic and probabilistic software. Seriously, this might be the most important intellectual concept in tech investing today. Deterministic SaaS handles mission-critical mathematical or legal tasks like HR, payroll, and compliance. They have a 0% error tolerance. Probabilistic SaaS, like basic customer service ticketing or marketing copy generation, relies on approximation, which is exactly what AI does well. If a company operates in a probabilistic battleground, AI is a massive threat. But if it's a deterministic stronghold, it's highly defensible. Think about it this way. If an AI chatbot writes a slightly generic marketing email, no one cares. But if an AI hallucinates an employee's tax bracket or messes up a corporate payroll run, that company is instantly facing massive fines and losses. These deterministic companies are prime examples of defensible systems of record. Veeva Systems and Metadata manage clinical trial data with incredibly strict FDA regulatory moats and meticulous audit trails. Procore has deep workflow embeddedness in the highly complex, liability-heavy construction industry. A free AI tool simply cannot, legally, practically, or operationally, bypass the high switching costs and 100% accuracy requirements of these platforms. AI can write an email, sure, but it cannot legally validate a pharmaceutical trial. But we have to talk about the dark side of this market too. Part 5. The AI pivot trap. Right now, we're seeing these zombie companies desperately bolting on AI vaporware just to pump their stock. I mean, we have Allbirds, a literal shoe company, pivoting to GPU as a service, and the stock surges 582% in a day. A legacy crypto token pivots to AI infrastructure, up 448%. This is a stark warning for all of us. The brutal truth is that 94% of legacy tech companies are spending on AI features that do not translate into actual earnings. They just don't have the specialized engineering talent or the billions in capital required to genuinely compete in the artificial intelligence space. And this creates a highly manufactured 72-hour liquidity trap that algorithms use to fleece everyday buyers. Let's walk through the mechanics of this trap step by step. In hours 1 through 4, high-frequency algorithms scan SEC filings for the keyword AI and automatically execute massive buy orders, creating an artificial initial surge. Between hours 4 and 12, social media influencers notice the green candles, generating massive FOMO that drives retail trading volume up 6,000%. By hours 12 to 24, we hit peak meme stock phase. This is the critical moment where company insiders and early institutional buyers quietly convert their debt and aggressively dump their shares right into the buying frenzy. Finally, by hour 72, the crash hits. The smart money is gone, liquidity totally disappears, and retail investors are literally just left holding the bag as exit liquidity for the algorithms. It's brutal. So what keeps everyday investors trapped in these failing vaporware tech companies? It's a dangerous psychological flaw called break-evenitis, also known as the disposition effect. It's that desperate need to hold on to a loser just to reach the original purchase price, actively avoiding the pain of realizing a loss. Just look at legacy Intel shareholders who waited decades to break even from the year 2000 tech bubble. As a cautionary note, don't let break-evenitis anchor you to dead money when there are massive, verifiable value gaps opening up elsewhere in the market. Which brings us to the big picture. Part 6, the contrarian sector rotation. Let's move to how this all builds together into a clear rotational strategy. Hardware and AI chips are bright green. Sentiment is absolutely euphoric. Valuations are at all-time highs. This is the crowded picks and shovels trade. On the other end, horizontal SaaS is deep red. This is where the disruption risk from AI agents is the highest. It's that probabilistic battleground we talked about. But sitting right in the middle is vertical SaaS. Sentiment is yellow, meaning cautious. Valuations are at multi-year lows, but their regulatory and workflow moats are incredibly resilient. That is your contrarian value play. We have to find the green fundamentals hiding underneath the red sentiment. And institutional money is already seeing this. Look at what Michael Burry's Scion Asset Management recently concluded. Their thesis noted that the massive software washout was largely driven by liquidity tightening and credit-driven selling exhaustion, rather than a structural decline in the software business model itself. It was a reflexive, irrational overshoot. That panic created a really rare margin of safety for the disciplined investor who is willing to look past the hardware hysteria.
We are rapidly moving from the hardware foundation phase of AI straight into the software implementation phase. Capital flows will inevitably rotate. So while the masses are out there fighting over $1,000 chip shares at the absolute top of the market, are you positioned for the software spring awakening? Look past the vaporware, find the mission-critical moats, and do not miss out on these 2018 valuations. Thanks for joining me on this explainer, and keep your eyes on the data.